services can be taxed in international trade. We talk a lot about the tariffs or taxes that a country places on physical goods, such as steel, aluminum, and automobiles, from other countries entering that market. But what about the apps, software, and streaming services that you beam across borders? They are often done through a digital services tax instead of tariffs. Hi, I'm Dr. Sarita Jackson, founder and CEO of the Global Research Institute of International Trade. Welcome to another episode of Trade on Tuesdays at 2, where we talk about international trade policy and practices, and I share 2 tips to help you navigate what is happening in today's international trade market. Under major trade agreements, such as the U.S.-Mexico-Canada Agreement or the USMCA, the 3 North American countries have agreed not to impose customs duties on digital products, such as software, video, or music transmitted electronically. You don't pay a tariff at the digital border. However, that same agreement has a loophole. It explicitly says that the ban on customs duties does not prevent a country from imposing internal taxes, fees, or other charges on those digital products if they are imposed in a way that doesn't discriminate against digital products produced outside of one's domestic market. Enter the digital service tax. Since countries can't charge a duty or import taxes on digital products at the border, some implement a tax on the gross revenue a company generates from users inside their country. This often targets advertising revenue, user data sales, or subscription fees. The U.S. government views these as trade barriers or digital protectionism, designed to target American tech companies. For a real-world example of how this is playing out in 2026, let's look at the Southeast Asian country of Malaysia. In the new U.S.-Malaysia Agreement on Reciprocal Trade, announced just months ago, Malaysia agreed to refrain from imposing digital service taxes or value-added taxes that discriminate against U.S. companies. Why was this necessary? Because without that specific clause, a country could technically comply with liberal trade while also taxing the data flows and digital revenue of firms located across borders and overseas, while leaving domestic companies alone. The takeaway? Just because your product and or service are digital, it doesn't mean that it's tax-free. Here are my 2 tips. Tip number 1, check to see if a country has signed a trade agreement with your country. For example, U.S. exporters, check to see if the export market of interest has already signed a trade agreement with the United States. And tip number 2, check to see what that agreement says as it pertains to digital services trade. Thank you for joining me on another episode of Trade on Tuesdays at 2.